Hello, in today's video we're going to be taking a look at the Wednesday, October 1st, 2025 trading session for the CBOE SPX index. We're going to be utilizing the new SPX Daily Key Levels V2.0 indicator for trading SPX 0DTE options. Okay, so the way this indicator works is that at 9:30 a.m. Eastern New York time, when your chart is on the SPX CBOE index on TradingView, you will see the various key levels on your screen that are relevant for today's session. The most important level of the session is going to be the SPX Bull Bear KPL, which stands for Key Price Level. This is the most important level of the session. This is the key bull bear pivot for the session, which determines the bias for the session. So it's bullish above and bearish below. Your main levels R1 through R6 above are your take profit levels for entries that are triggered from the bull bear key price level. So specifically bullish entries that are triggered from the BBKPL level, your main levels above are going to be your take profit levels. Conversely, your main levels below, S1 through S6, which for this particular session, we're not showing the rest of the S levels because this was a bullish session. But you can see here on this reference table that you can enable on your chart. You have S1 through S6, and then you have R1 through R6. This other table here, which is also optional to display, displays the SPX Pre-market High, which is PMH, SPX Pre-market Low, which is PML, SPX YDH, which is yesterday's RTH session high, SPX YDL, which is yesterday's RTH session low, and SPX YDC, which is yesterday's RTH session close. Those levels are referenced here, as you can see. Okay, the next thing is the stop loss levels. So at the end of this video, there's going to be an extended 20-minute or so video attached to this video today, which is going to go over trade entries from all levels, not only the bull bear key price level, but how to take entries from the other main R1 through R6 levels and S1 through S6 levels. Today's video, in the first part of the video, we're just going to be focused on this bull bear key price level entry because that what was relevant today. But if you want to watch the end of the video, the last 20 minutes of the video or so are going to go over taking either bullish or bearish entries off of the other levels and how you do that and what your entry signal and what your stop losses will be for those. And it will also go over the two different types of entry signals, your standard entry signal and then also your more conservative entry signal. So that'll be in the last 20 minutes or so appended to this video. Okay, so let's just jump right into this entry here. So this is the 9:30 opening candle for today's October 1st session. It's this candle here. As you can see here, we did have a cross of the bull bear key price level, cross above and close above. So a cross above and close above the bull bear key price level is your signal for your standard entry for a bullish play for this level. So this is a 2-minute chart. This indicator works on time frames of 1 minute to 30 minutes. So the minimum time frame would be a 1-minute chart, the maximum time frame a 30-minute chart. the recommended time frame to use for intraday trading, which you will also see on all of our videos, is a 2-minute chart. However, other people like to use different chart time frames, which is fine. It does work from 1 minute to 30-minute time frames, but the recommended time frame is the 2-minute chart. Okay, so we have a cross above, close above on this opening candle here. So at this time, you have 3 different options as far as the call options that you can enter with. Your primary option is going to be an at-the-money call option, which is the at-the-money 0 DTE strike that is closest to today's BBKPL. Since this signal is from the BBKPL, then we would be choosing a strike as our primary option. That would be an at-the-money strike closest to this price here of 66.5940, which that would be the 66.60 call. Your second option and third option would be slightly out of the money options. How you determine which strikes to use for those is as follows. You look to the first midpoint above, which is the mid BBKPL R1, which is 66.6526. So the strike closest to this price is 66.65. So that would be your alternative if you wanted to instead use an out of the money option, having less money to lay out for this bullish entry. And the final option would be just one level above. So the R1 level above is 66.7111. So the closest SPX strike to that is 66.70. So that would be your 66.70 0 DTE call. So an at the money is 66.60, slightly out of the money 66.65, and the furthest out of the money call you should consider for a play that is triggered off of the bull bear key price level on a bullish entry would be the strike closest to the R1 level, which is 66.70 call. Okay, as you can see, we have outlined here in this comment here, bullish entry on 9:30 a.m. candle cross above and close above the BBKPL. Either use at the money put strike closest to BBKPL of 66.5940, which is the 66.60 0 DTE call option. The entry price on this candle close here, which remember this is a 2-minute chart, so this candle closes at, this is the 9:30 a.m. candle at the market open, so it closes at 9:32 a.m. The entry price on this 66.60 call on this candle close is 17.80. And we will take a look at the Thinkorswim option chart so you can see the data boxes for both the entries that we'll be pointing out here as well as the various level hits, so you can see that the prices here that we have match the data boxes that are in Thinkorswim for these various options. And we have what we outlined here, or use out of the money call strike closest to mid BBKPL R1, 66.6526, which would be the 66.65 call. The entry price on the close of this candle for that call was 14.70. And finally, the furthest out of the money strike based on the R1 level, 66.7111, is the 66.70 call. And the entry price on this candle close for the 66.70 call was 11.80. Now, what about stop losses? There's 2 different options for stop losses. And again, we'll have a portion, a 20-minute portion appended to this video that you can watch, which will be the last 20 minutes of this video, which will go over stop losses as well as entries on all the different levels so you can understand how to utilize the indicator for those too. Keep in mind there is no obligation to take this particular trade. It's just that usually at the beginning few moments of the session, your trade entries are 90-95% of the time going to be based on the bull bear key price level, like it was today. Okay, so the stop loss, you have two different options. So first you have the level that the entry is triggered from, which in this case bull bear KPL. Your two different options are you can either use the standard stop loss. The standard stop loss is the first midpoint level below the entry level that the signal was triggered from. So the level that the signal was triggered from is BBKPL, so we simply look to the first midpoint below for our standard SL, and that is the mid BBKPL S1 66.53.55. That is your standard stop loss on this bullish entry. It's recommended that in most cases to use the standard stop loss. However, we do also provide a tight stop loss level for those people that prefer to use tight stop losses as opposed to the standard stop losses. But you just have to keep in mind that in a lot of cases, the tight stop loss, since it is going to be closer, is going to be more of a chance of it getting hit. So, as happened today, which we'll get to in a minute. Your tight stop loss on this same entry, if you did not want to use the standard stop loss, is the first quarter level, which we have abbreviated on our indicator here as QL. It's the first quarter level below the level that it was triggered from. So in this case, BBKPL. So your tight stop loss is the QL below BBKPL, which is this level here. Okay, as we can see, price did rocket up to the mid R1, R2 level here before turning around and retesting the BBKPL. As you can see here on this 950 candle, you did get a hit on this wick of the tight SL. So again, that's one of the reasons that we recommend using standard SL on most entries. However, we do have the tight SLs for people that prefer using those. We also have bullish entry here, number 2. And the reason that we're pointing this out is for two reasons. One, if you did use a tight SL and you were stopped out here, then you could have re-entered here on this 9:52 a.m. candle, which also crossed and closed above the BBKPL. And then here are the prices here. These prices are slightly less compared to these prices because it's a little further on into the session, as well as this cross and close here is a little closer to the BBKPL compared to this one. So as you can see here, the entry on the 66.60 call at the 9:52 a.m. candle here was $15. The 66.65 call was $12.10, and the 66.70 call was $9.70. So if you did get stopped out here because you used a tight SL, then you could have re-entered here. The second reason we're pointing this out is this also could have been an add-on if you wanted to add to this position here while still using your standard stop loss. So those are for people that like to add on to positions. You could have added on and scaled in a little bit more here if that is your preference style of trading. Most people are going to just enter here, use the standard SL, and let the trade play out. This section up here, which goes over the profits, is just going to be the profits and costs based on the initial bullish entry here, because I said most people are taking this entry if they're trading off the BBKPL and using the standard SL, so they would have not got stopped out here. Okay, so moving right along here at 10:34 a.m., the SPX hits the R2 level here. And remember, as we talked about, these levels above are your take profit levels. Okay, so this is your R2 hit at 10:34 a.m. The 6660 call is 2665 now. On this candle close, the 6665 call is 2250. So the 6660 call is 2665, the 6665 call 2250, and the 6670 call is 1850. So as you can see here, we have a nice profit so far. So we have a 2665 here. We paid 1780. So on this R2 hit, we now have $885 profit per call option. So if you're just using one call option, you have $885 profit on this R2 hit here. If you're using 5, then you have around $4,400 in profit. And if you were using 10 options, then you have around $8,850 in profit. And on the other options as well, you have some very nice profits compared to the price, with the most, with even the furthest out of the money that you paid $11.80 for, the 6670, it's now $18.50, and you have $670 profit per call option. But remember, you only paid $11.80. And then if you got stopped out and re-entered here, or if you added on here, then you can figure out what the additional profits would be, or your profits from this entry number 2, as we follow along here. Okay, so next up at, so we had 10:34, so roughly an hour later, at 11:28 a.m., it hits YDC level. So the YDC level, as we talked about, was yesterday's RTH session close. So now we have price hitting the YDC level, and the 6660 call is now 29.70, the 6665 call is now 25, and the 6670 call is now $20.60 on this candle close. That would be this one here, excuse me. Just one candle later, at 11:30, it hits the YDH level. Remember, the YDH level is yesterday's RTH session high. So when it hits that at 11:30 on this candle close here, the 6660 call is now 32.80. The 6665 call is now 28.20. The 6670 call is now 23.60. Just 6 minutes later at 11:36 a.m., it hits mid R2, R3. So mid R2, R3 is the midpoint between R3 and R2. When it hits mid R2, R3 on this candle here at 11:36, the 6660 call is now $34.90. The 6665 call is now $30.20, and the 6670 call is now $25.70. So as you can see here, after hitting here, it has a sideways move. Then it goes back down to test the YDH level, yesterday's RTH session high. So it goes back down to test, test again, one last little fake out here, and then close back above, and it starts moving fiercely again on these candles here to move up to the R3 level. It came close to hitting it here, but it actually hits the R3 level here at 2 p.m. On this R3 hit, your 66.60 call is now $48. Your 66.65 call is now $42.30, and your 66.70 call is now $39.15. So at this point, if you look over here, you can reference the profit per call option as you follow these along. Right now we're here at 2 p.m. So at 2 p.m. when this 66.60 call hits is 48, that's now a profit of $3,020 per call option. So if you were trading one option, you'd have $3,020 profit at this point. If you were trading three options, you'd have $9,060. If you were trading five options, you'd have roughly $15,100. And if you're trading 10 options, you now have $30,000. As you can see, even the furthest out of the money option that we had down here to choose, which was the least expensive of the three, at $11.80 per call option with an entry price of $11.80. The cost is $1,180 per call option. At the R3 hit at $39.15, now you have a profit of $2,735 per call option, and you paid $1,180 per call option. And here finally, at 2:48 p.m., we get a mid R3 R4 hit. The 66.60 call, this mid R3 R4 hit at 2:48 is now 57.80. The 66.65 call is now 53.20, and the 66.70 call is now 48.10. So if you reference here, the 66.60 call that you originally paid $17.80, which is a cost of $1,780 per call option, is now $57.80 at a profit of $4,000 per call option. So if you had one option, that's $4,000. Three options, that's $12,000. Five options, that's $20,000. Or 10 options, that's $40,000. If you look at the furthest out of the money option that you had starting back here, your 66.70 call is now 48.10. That's a profit of $3,630 per call option. Your price that you paid was $11.80, which is $1,180 cost per call option. Now with the $3,630 profit per call option. Okay, next we're going to look at the Thinkorswim data boxes for these three different call options. First up, we're going to look at the primary option play, which was the at the money 66.60 call option. So here we have the times marked off for each of the level hits we went over here, and these are the data boxes for those times. So this is a 2-minute chart for the 66.60 call option. Okay, as you can see here at 9:30, the close 17.80. And then you had entry number 2, which if you missed out on the 9:30 entry, or if you got stopped out, because remember we said if you use the tight stop loss, you got stopped out. However, if you use the standard stop loss, you did not get stopped out. So if you use this 9:30 entry and you got you used the tight stop loss, you would have gotten stopped out, and then you could have re-entered here on the second cross and close above the BBKPL. If you used a standard stop loss, then you did not get stopped out, and you would still have your entry from here, unless you also wanted to add on more calls at this point on this candle. But as you can see here, the close here on this candle, 952, candle $15. Here's the 10:34 a.m. Candle where it hits the R2 level. As you can see here, the close of this candle, 26.65. These are pretty close together. That's why this text looks kind of bunched up, because remember we had the YDC and YDH hit that just happened. One happened one candle after the other. So 11:28 it hits YDC, which is this line here. And this candle here is now 29.70. Here's where it hits the YDH level on this candle here. It's now 32.80. Here's the 11:36 candle where it hits the mid R2, R3 level. It's 34.90. Here's the 2 p.m. candle where it hits the R3 level. It's now 48. Here is the 2:48 p.m. candle, and when it hits mid R3, R4, and it's 57.80. Next we'll look at the 66.65 call option. Okay, this is the 66.65 call option. Here we have the 9:30 entry candle, which was entry number 1. Close this candle, 14.70. Here's the 9:52 a.m. candle, which was entry number 2. If you happen to get stopped out or you wanted to add on, remember, you only got stopped out on this entry number 1 if you used a tight stop loss. If you used the standard stop loss, you were not stopped out. Here you could have bought again at $12.10. Here's the 10:34 a.m. candle here where it hits the R2 level. It's now $22.50. Here's the 11:28 candle where it hits yesterday's RTH session close, the YDC level. It's 25. Here's the 11:30 candle where it hits yesterday's RTH session high, the YDH level. It's now 28.20. Here's the 11:36 a.m. candle where it hits mid R2, R3 level. It's now $30.20. Here is the 2 p.m. candle where it hits where it hits R3. It's now $42.30. And here is the 2:48 p.m. candle here where it hits mid R3, R4, and it's $53.20. Next, we'll take a look at the furthest out of the money option, which was your cheapest alternative for the entry at the 9:30 a.m. candle. Okay, so here is the 66.70 0 TTE call option. This was going to be your cheapest option to get into on our 9:30 a.m. entry candle. As you can see here, this 9:30 a.m. candle, on the close of that candle, it's $11.80. Here's the 9:52 a.m. candle. So if you used a tight stop loss on this 9:30 a.m. entry and you got stopped out, the stop out would have occurred on this candle here. And then you could have re-entered, on this candle here, and then you could have re-entered here on the 9:52 a.m. candle as we talked about. Remember, if you used the standard stop loss on your entry number 1, then you did not get stopped out. But if you did decide to add on to your entry here, or if you did get stopped out and you re-entered here, that was $9.70. Here's the 10:34 a.m. candle where it hits the R2 level. It's now $18.50. Here is the 11:28 candle where it hits the YDC level. It's now $20.60. Here's the 11:30 a.m. candle where it hits the YDH level, $23.60. Here's the 11:36 a.m. candle where it hits mid R2, R3. It's now $25.70. Here's the 2 p.m. candle where it hits the R3 level. It's now $39.15. And then here we had to use the 2:50 p.m. candle because this candle here, I believe, is the 244 candle. So there was no 248 candle, probably because there was no trades. However, if you do look at the open of this candle, remember the 2:48 p.m. candle closes at 2:50 since this is a 2-minute chart. So if you simply look at the open of this candle here, and as you can see, you had many other opportunities to get out even at a higher price when it was traveling sideways across and kind of chopping up and down on that level. So there were plenty of opportunities to get out in the 40s and mid 40s for here. Okay, now we're just going to go back to the main chart. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC. And we move down, here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL, and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPL S1 for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1, R2, mid R2, R3, mid S1, S2, and mid S2, S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1, and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is the QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1, and you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level, your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, if we were taking a trade of a breakout above R1, and we're taking a bullish trade, then our tight stop loss is the QL below R1, because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1, because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say the price goes up to R2. Now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1, or break below R1, or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level, then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3, because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. the opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking a bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1 because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level. That is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question, and that is your successful retest. So you would enter, you could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. Since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.